What's the Risk? Hosted by myself, Daniel Crowe, and Peter Mansell, founder of Mansell Financial Group, a financial advice business he founded in 1980. This is a simple video series we hope investors can use to better understand index and portfolio performance, along with addressing some investment questions and dilemmas. This episode is about the recent First Guardian collapse and some other collapses, Master Shield, I believe, Shield Master Trust, and Australian Fiduciaries. There's some common themes here that we've encountered over the years and how investors end up in these things. One thing to note, the ABC has reported the liquidators noted much of the money invested had gone to illiquid investments such as property developments and equity positions in related companies that may have a shared common director with the company, and that's never a good thing to hear. So Your Investment Philosophy, book we wrote, shameless plug, available at Amazon. Disclaimer, please pause and read. Suffice to say, our intent is educational and not rendering financial advice. Now, as it stands, here's where we are. Now, unfortunately, people who watch this video are likely to be those affected by it, and maybe it won't be seen by those who were trying to protect. But, we've certainly tried to highlight similar things in the past. And look, it's quite outrageous that people have been churned into this garbage. It's sold as diversified and liquid asset pools, when on the evidence at the moment, it's undiversified, illiquid related party trash. And Tony Boyd at the AFR says what he's seen is the assets are probably worthless. And the funds were on known platforms. They're given favourable ratings by research agencies, and everyone right now is just pointing the finger at everyone else, trying to say, well, it's not my fault.
It's a very, very sad outcome. And unfortunately, after 4.5 decades in financial advice, this is not the first time I've seen these sort of outcomes, and it surely won't be the last. But, to see 12,000 people's, retirement savings decimated, is a very, very sad outcome. But it's underpinned by some really bad behaviours by unscrupulous people.
Some investors say they were in these things and didn't know, and some of the advisors the people who were advised were operating on a negative consent model, whereas the client didn't respond to a change request. It was taken that it wasn't a problem and they could be switched into it. And, frankly, you'd fire those advisors into the sun. But
I'd just like to respond to that, and that is that every financial advisor on the financial advisor register, when dealing with retail clients, has no option but to gain positive consent from clients. So to have reacted to negative consent, to use the phrase that you've used there, Daniel, is completely at odds with the legal responsibility. To be led astray using that negative consent concept is very sad from both fronts.
And aside from that, we've talked about this in the past. We've made videos, written blog posts about this churning and comparison stuff. Investors need to be on guard, because a lot of this starts with, the idea is your super measuring up? Get a review. How are you performing? How much have you got? Where are you positioned? And most of these comparison websites are set up to basically get your details and then harass you until you break. And at best, they'll just churn you to a new fund or platform to clip a fee. And at worst, it might be outright fraud, as it was in this case. Now, the reality is your fund could be fine, but they're going to tell you that your current fund is terrible, trying to undermine trust in it. They'll say, well, take care of it. They probably won't. They'll do a bad job. And, I think the media really needs to sort of really needs to have some culpability here, because they're always going on about how much super do you need? Take control. How much should you have? And it sort of plays into that thing that you need to change, or what you're currently in may not be performing. And over the longer term, the funds where these people are being taken from, which are obviously industry super funds, are quite fine, but they're being taken out of those funds on the promise of higher performance.
Absolutely. Historically, we've seen industry super funds, well-managed, low-cost index funds, and other high-quality investment offerings perform very, very well over many, many decades. And the promise of higher returns, at any given point in time, will almost certainly be based on very short periods of information that realistically can't be relied upon. And the investors that leave the good, sound, reliable solution to pursue something better, almost certainly are going somewhere where it's more expensive, more illiquid, less diversified, shorter track records, and frankly, very little chance of success.
And thinking someone will save you, it's important not to think that ASIC is a bulletproof vest, because probably the best analogy here is like a TV cop show with Law and Order. They're investigating a murder and they arrive when there's a dead body, and that's the aftermath. They arrive when the money's gone and looking for clues. And there'll always be plenty of talk about, what will be recovered, and compensation schemes are last resort if via advice. That might be the case, but always talk like the government might step in, there might be insurance, and there's always these hopeful statements. But at the end of it, it's best not to be in these situations in the first place. If you're in a big industry super fund, there's probably no good reason to leave, especially if you have NFI.
When you consider that the vast majority of investors, particularly average mum and dads across Australia, they may have skills in their particular chosen field. They might work in local government, they might work in state government, they might work in health, they might work in construction. They might have a high level of skill in their chosen field, but managing investments is probably not going to be one of them. And to be, for want of a better phrase, trying to rely on someone else to protect you after being hoodwinked by one of these people is most unlikely to be something that you can rely upon. I've watched this over, as I said, more than 4 decades, and collapses in the past have rarely seen the end investor end up in the position they would have been if they had just stayed where they were. I've seen so many examples of it where the get-rich-quick scheme, we can do better for you scheme, we've got the new thing scheme, they just result in tears. If it's not your field of expertise and knowledge, for heaven's sake, stick with proven approaches that have stood the test of time and do work.
Even if the money is recoverable, you are going to go through an enormous amount of stress in the time from when you find out that something has gone wrong until you actually do get some money back.
We see many an example of it. One particular local experience recently, a younger couple approaching retirement had trusted their super or had been talked out of staying in industry funds to set up a self-managed fund by their accountant that was supposedly acting for them. Turns out he's not the least bit reputable. And where's the money? Nobody knows.
And that was very similar. It was a liquid, related parties, and for anyone who could just take a look at it, had a little bit of knowledge, you could see it was complete garbage. But for these people who had expertise elsewhere, they didn't know what they were being put into. They just believed the accountant and the financial advisor that he'd got to set it all up. And
absolutely. Yeah, absolutely. Complete conflicts of interest, at every level. But because the end investor didn't have the knowledge to understand that, they paid a terrible price.
And these are your retirement savings. And it is really hard to educate people quickly on how to protect your super. But overall, you probably make 2 points. Firstly, be more skeptical, because if someone is attempting to sell you on something and you don't understand it, you just have to be as skeptical as possible. And secondly, you need to be brutally honest with yourself about what you know and what you don't know. It's better off to say, look, I have no clue about this. I don't know what you're pitching me, and just keep away from it, especially if you're already, as we've said, in a industry super fund that's well regulated and you're being cajoled into switching from that into something with the promise of higher returns elsewhere.
I have said for decades and decades to people, if you don't understand the risk in an investment, don't invest in it. And if somebody tries to tell you that they can show you a low risk, high return investment, one of 2 things is happening. Either they're deliberately misleading you, or they just don't understand the risks within the investment. So if you don't understand the risk, don't do it. And if someone's trying to convey to you that they've got a high return, low risk investment, just don't believe them.
Don't buy into stories that undermine trust. There's a lot of stuff out there now. talking about you need more control, when multiple studies show that the less control and less you do is probably better for you as an investor. There's a lot of stuff out there too now about Vanguard and BlackRock and State Street controlling the world and doing this and that. And that's another thing that undermines trust in things that are existing and established entities. If people are trying to undermine those things, that's how that you can lose trust and you can be lured into making bad decisions. So other things like saying index funds are Ponzi schemes, or your brother-in-law tells you your super fund is crap, or another thing, industry super. There's always talk about industry super, and we're not here to advocate for them anyway, because I'll actually say that their customer service may actually be quite abysmal, but it's hard to argue that they aren't reliable investment options after this time that they've been around.
Absolutely. Absolutely. Look, there's some really good points on this screen. The notion of needing more control over your super, that's fine to want and take more control if you know what you're doing. I don't know how to do brain surgery, so I'm not going to bother trying to learn it either. I'd rather trust someone that's all they do for the whole of their working life. You know, the criticisms of the likes of, the behemoth fund managers like Vanguard and BlackRock, a lot of what they do is incredibly sound and uses methods and approaches that people can rely upon. Those that criticise them are those that believe they can do something better and predict this or predict that, pick the next winners or the like. They're just trying to wedge people's confidence away from those that have got tried and true reliable methods. The notion that index funds are Ponzi scheme, frankly, is laughable. That again is just a promotion, by someone that's trying to wedge their own niche within a market. Forget about what your brother-in-law says. He may know. Chances are he doesn't. And whether it's the industry funds or the big, corporate funds, these people largely know what they're doing. You're definitely better off to stick with them. And more broadly, if someone's trying to sell you a concept by just attacking what you've already got, ask yourself the question, are they trying to help you or help themselves? People who tell you what you need to hear are doing it for your benefit. People who tell you what you'd like to hear are almost certainly doing it for their benefit.
And just, again, don't give out your details. If you don't understand something, don't switch to it, especially on the promise of higher returns, which can never be guaranteed. We will make the point again, like some people or investors in these situations were put into these things by unscrupulous people who they thought they were in something else. So obviously in those situations, if your SOA said one thing and you're actually invested in something else, we really can't do anything there. What can you do, Peter?
Well, you can't. At the end of the day, if someone is going to deliberately mislead you, there's almost certainly nothing you can do about that. What you can do about it is don't get involved with people that try to convince you to leave what is a tried, tested approach to managing your retirement saving, one that's been adopted by hundreds of thousands of people, one that's got a lengthy track record. Just don't leave. The last line there, and I think the next slide brings it up, in 45 years in this business, we've concluded that there's basically 5 things with investments that stand the test of time. They're outlined thoroughly in the book, and that is that investment risk and investment returns are inextricably linked. That won't change. We know that financial markets broadly are very, very efficient, which means people don't get lots of information that they can use to do better and take advantage of everyone else in those investment markets. We know that diversification does reduce risk. Harry Markowitz won a Nobel Prize for that, and it's accepted right across the financial sector globally. We know that the asset allocation that you use to build a portfolio is the thing that drives your returns, nothing else. Macro asset allocation is the key driver of your returns. And once you've settled on an investment philosophy, if you stay disciplined to it, you will be successful. People who want to chop and change and follow the fads that come along, from time to time, they inevitably lose. Those that show discipline inevitably win. It just takes them some time. Those 5 things are the key drivers of your investment success, and 45 years in this business has taught me those 5 things are what people should rely upon.
And final point, our business has never had any investor in an investment failure like this.
Absolutely not.
Finally, sources and descriptions of data. Thanks for your time.
Okay, thank you.